think that the real crush is going to happen in 2024 because you've got an enormous volume of loans coming due that no longer underwrite, having been a lender. Okay, you can no longer underwrite based on their cash flow or based on their value.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show on YouTube at youtube.com/GowerCrowd and at good podcasts everywhere. Welcome to this week's episode of the Real Estate Reality Show. My guest today is Henry Lorber, who is principal of Henry Lorber and Associates. Now, what makes Henry stand out among just about everybody else that I know in this industry is that this downturn is actually his fourth downturn. And depending on how you define downturns, I'll be much more precise and tell you that this is actually, that his first downturn was during the 1970s. Oh my goodness me. Henry has been dealing with distressed real estate assets and performing and non-performing loans his entire career. It's a very, very long time. So what you're going to hear today are some deep insights into how the current downturn compares with prior ones, as well as undoubtedly learning something about downturns well before almost all of our time, certainly before my time. My first downturn was the late 1980s. So he predates me by, goodness, at least 10, 15 years. Oh my goodness me. Anyway, very interesting conversation with Henry today. I actually decided to contact him to see what his thoughts were because he posted he was actually quoted in an article where he derided crowdfunding as a good idea or as a bad idea for commercial real estate. So I wanted to take him up actually on that observation, see what he had to say. And we ended up talking about all kinds of other things. You're going to find the conversation with Henry very, very interesting. If you would like to find out more about Henry, go to the podcast page at GowerCrowd.com. While you're there, of course, subscribe to our newsletter. But at the bottom of the podcast page about Henry is a link to his LinkedIn profile. You should definitely take a look at that. I mean, he really is a man of incredible experience and insight going back many, many decades. All right, that's it. Anything else to tell you? I don't think so. So why not? Let's just get on with a conversation with Henry Lorber, principal at Henry Lorber and Associates, all about downturns, what they look like and how they compare. Here he is. Henry, it's a pleasure to meet you. Thank you so much for joining me on the podcast today. I'll tell you what, the reason, and there's lots to talk about because you've been around a very long time in this industry. In fact, one of the only people I know that's actually been through 4 downturns. Oh my goodness. Real estate downturns. But the reason that I contacted you in the first place is because of a quote. I think it was in a BizNow article, and you were talking about about crowdfunding. You said it is probably, I'm going to quote it to you because I thought I've got to talk to you about this. Crowdfunding. Quote, "It is probably one of the single worst investment strategies I've ever heard of." Lorber says, "Crowdfunding for real estate, it's nuts."
If that is not precisely the quote, it is real close to what I think.
Tell me why. Come on, because I think it's the best thing since sliced bread, but I would love to hear what you have to say. Tell me why.
I think there are basic problems with the structure. Okay, when you invite people, and by the way, the asset that I was talking about is a place where I had an office, so I knew it quite well. All right, and it's a lovely building, but it's got its own issues because it's an office building in a major area.
Yes. Okay. Right. So this was about and you know, it's. I'll let you talk names if you want to. I'm not sure how discreet you want to be. Doesn't really matter. It's totally fine. But this was a major office in downtown Manhattan, wasn't it, that had been
No,
financed?
it was in the area of Atlanta known as Buckhead. Okay.
Okay.
And it's a major complex. The problem with this particular transaction was multiple, but the real issue was you have investors putting in as little as $25,000, and other investors putting in as much as $1.5 million. They therefore have very little in common about their investment strategies or their investment abilities. So when the market is moving up, it's great. Everybody gets a piece. Okay. When the market is moving down, and I don't know much about that particular Nautilus transaction, but my guess is there was no ability to go back to what I'll call the limited partners or the crowdfunders, okay, to get additional money to deal with some minor issues like tenant improvements, like you need more money to purchase the property. Okay, all those reasons, those investors their whole theories are divergent.
Okay,
This is real common if you look back, and I apologize for taking you back a little ways. If you look back to the whole concepts of tenants in common, which was the same concept that exploded in 07 and 08, they were taking money from hundreds of investors, many of whom had different interests, different amount of abilities, different abilities to invest additional money. And the sponsors, Nautilus, were unable to go back to people to get additional money without getting a significant portion of those investors in agreement.
Well, I think with a TIC, it had to be 100% agreement, didn't it?
Okay, so there's your breakup right there. But in the case of the Atlanta Financial Center, which was the asset I was talking about, I think the number was 874 individual investors. Even if you only need half of them, good luck.
Well, hang on a second. So let's just really drill down on this, because it's a very interesting point that you make. And you've been in this a very long time, so it's actually a very sophisticated observation. The idea, I think, let me try and come back to you and just explain what I think it is that you're saying. So a sponsor that would buy a multi-$100 million, let's say, office tower, would typically, they would seek a financial partner to an institutional investor who would be able to work with them during times of distress or during downturns. So they would go to that single partner, that one partner who wrote one check, right, an institutional investor, and they would be able to raise the money that they needed potentially for whatever they needed if the market went down. The challenge that you're describing is that when you have hundreds of small investors, they don't have that kind of flexibility. Is that the issue that you're talking about? Is it an error made by the sponsor, a strategic error made by the sponsor by using investors who cannot help them if times get tough?
Absolutely. And I've seen this. I mean, the reality is anybody who has ever done a syndication, old-fashioned syndications, okay, to buy real estate, as I remember, the rule was your investors had to have a net worth in excess of $250,000, or they had to have equity of $250,000. I don't recall what the rules were then. So they had the ability, if you needed, I mean, I'm involved in a deal right now where there's some litigation, okay? And the sponsor has come back to each one of us saying, need some more money. And basically, we have all contributed whatever he needed in order to deal with the asset. Don't assume that buyers of major properties have institutional partners. They don't always have institutional partners. Years ago, I did syndications with a major New York City law firm whose partners were also in the deal, as were the clients of the tax department. They knew full well that if it didn't turn out the way the pro forma promised it was going to turn out, that they were going to need to write additional checks.
Right. So
That's what you're missing in this scenario.
Right. So I have to jump in here. I knew we'd get into this a little bit. There is confusion in the market. And I see this in articles, in newspapers. I see it in commentary on LinkedIn. And there's just confusion about what crowdfunding is. So let me clarify exactly what it is. Just because there is this misunderstanding. First of all, an accredited investor, just FYI, an accredited investor, and it's always been the same standard, Henry, since 1982 when the SEC first applied the standard. The standard has never changed, or basically not changed. You have to have 200,000 of income for the last 2 years and a likelihood of earning the same this year, or 300 if you file jointly, or a net worth of $1 million or more. And one of the big changes was that cannot include your primary residence. It used to be that you could, right? In 1982, you could include that, but you cannot do that now. So that's the standard. Now, the deal that you're talking about, and I thought it was actually one of the Nightingale deals in Manhattan, that it wasn't the Atlanta deal. But either way, in order to be able to raise money from individual investors, 99% of the time, they are always accredited investors, exactly what you're talking about. In other words, the term crowdfunding is actually synonymous with the term syndication. When you crowdfund a deal, this is the confusion. When you crowdfund a deal, 99% of the time, you're actually just doing a syndication and you're raising money from accredited investors. Now, there is a crowdfunding component or regulation called regulation crowdfunding, where you can raise money from non-accredited investors, low income, low net worth investors. That's not what we're talking about. So the example that you give that this particular building could have gone back to high net worth investors, those 800 people almost certainly were all high net worth, i.e. accredited investors.
Self-certified.
No, not self-certified.
Okay.
So there's two regulations. There's Regulation D 506B. Now that's the old one. That's the one that you're probably used to. I mean, you go back to what you said in the email you sent me, the 70s. I wasn't sure if it was the 1870s.
Thank you. I appreciate
it. It might as well have been, but the 1970s. You go back a long way. So up until 2012, the regulation was Regulation D 506B, and that allowed for self-accreditation. When you've got 800 investors, and I'm not sure what this deal is you're talking about. Again, I thought it was one of the Nightingale deals. The crowdfunding of today is Regulation D 506C. That requires reasonable efforts by the sponsor to essentially verify somebody is accredited. And that means self-accreditation doesn't work. You got to go to a third-party accreditor. You got to get a letter from a CFA, CPA, lawyer, whatever it is. No self-accreditation. So we are talking about the same thing in theory. Again, this is why I struggle with the term crowdfunded. But a crowdfunded deal that goes to only accredited investors, if your theory is right, they should be able to go back to those investors. But the question is, how do capital calls work at the end of the day anyway? Even an institutional investor might say, pound sand, you've lost the deal.
And I'm going to apologize. You're right. It's Nightingale, not Nautilus. That's my
that was it, right? It was.
Yeah, that was it. That was my mistake. I'm dealing with a different Nautilus matter, but that's unrelated.
Okay.
Okay, but so we have 874 people, and you come back to me, and I bought my wife a condo 2 days afterwards, and therefore I don't have that liquidity that I really had perhaps on the day you did this deal. I'm going to tell you to go pound sand. And I don't know, in the case of these Nightingale funding deals, what percentage of the 874 have to commit, because you've got people who put in 25,000. That's great. You got people who put in $1.5 million. That's not so great. There are all sorts of other issues here, okay, relative to this particular deal. like asking the Japanese insurance company who owns the property to take a $70 million hit on the purchase price. You can write not likely under that concept. Okay. But so you've got too many people with too many different varieties of investments and investment philosophies. It doesn't work.
I tell you what, let's back up a little bit, Henry, because you do go back a long way, and you have had you've been through 4 downturns, which makes you very unusual in this world. Even before the RTC, I know you worked at the RTC as well, so I think that must be how you know Colony. So tell me a little about what Lorber and Associates does. Just why don't you explain a little about your background so everybody knows where you're coming from and who you are and what you've been through. And see,
I've been doing this since I did this for Citicorp back in the late 70s and early 80s. And then I got dragged into working for the Maryland Deposit Insurance Fund, which was a failed group of banks up in the state of Maryland. I then went to the Resolution Trust to run a third-party asset management program, which was called SAMDA, Standard Asset Management and Disposition Agreement.
And that was in the 90s, wasn't it?
And that was at the end of 89, or early 89, I guess, through the middle of the 90s. Okay. And then starting in the 2000s, when the crash happened, the great financial crash, I was consulting to a number of banks, some of which made it, some of which didn't make it. Okay. I then became a receiver, and I've been a receiver on about 70 or 80 different deals. Okay. Many of which got cured. So my receivership business turned to family conflicts. If you've got siblings, you understand what family conflicts are like. One particular one was $60 million worth of assets, mostly environmentally contaminated. Oops. Okay. So that's my experience. So I think I've dealt with every type of real estate loan, maybe with the exception of industrial.
Oh, so, but in essence, your entire career for really a long time, millennium is entirely distressed real estate, right?
Absolutely. And because of it, what I tell people is when the phone rings, I never have a clue what's coming on the other side. It can be all sorts of different opportunities. But
so what are you seeing going on in the markets at the moment, and how is this? Well, let's start with that question. I want to put words into your mouth. What are you seeing going on in the commercial real estate market at the moment? Are you getting busier, or is it business as usual?
No, it's interesting. Everybody is afraid to catch the classical falling knife. So nobody knows where values are right now. Okay, that's probably true for most asset types. I'm seeing office buildings trade at 50 cents on the dollar. Even full office buildings trading at 50 cents on the dollar. Banks deciding we want out of here. Okay, most of what I'm seeing multifamily, nice looking products go from, and these are generic Atlanta area, southeastern numbers, go from $220 some $1,000 per apartment to $170,000 per apartment.
That's huge. That's almost a 25% decline.
Exactly.
Why? What's happening? Why?
Because okay, so there's limited financing. Okay, many people are caught with older properties. Anything that was built in the 70s probably wasn't meant to last 50 years. And therefore, you name it, it's going to go wrong. From the appliances to the roof to the downspouts, et cetera, et cetera. So everybody's backing away. What's going on most in general is there are very few transactions. Everybody's kind of waiting to see what's going to happen next. And nobody, and with all due respect, nobody knows. Nobody.
So well, I know nobody knows, but I'm going to ask you what you think is going to. I'm going to ask you to do some predictions. Having been through it so many times, you've seen interest rates driven up in your career. You've seen them driven down. You've probably never seen them driven up as quickly as we have now. What's the impact, and where do you think we're headed? I mean, that should be my last question, but I'm asking it now. Where do you think we're headed? What kind of you talk about a falling knife, right? So what does that mean? Where do you think the market's headed, Henry?
Let's break the markets into property type.
Mm-hmm.
Okay, and once again, I'm going to separate. Industrial because it seems to have its own life, except for older industrial buildings, which seem to be, at least in this market or these markets, they seem to be suddenly retail sites. Okay, which makes a whole lot of sense. For office buildings, I think 50 cents may be the new number. You just don't know, because that is compounded by the whole problem of getting people to go back to the office. Okay, I mean, my daughter-in-law works for a high-tech company, and the high-tech company is not based in Atlanta. I think she's been to that office once in 2 years. Mm. The rest of the time she's operated. She doesn't need an office as such. So what's the new with 20 million square feet or whatever the heck it is of new space coming online, in addition to sublet space coming online? I think 50 cents is the new number. And
right, but this depends on location, though, doesn't it? Because we have clients, for example, in LA. And other major cities that are really struggling with their offices, and we have major downtown skyrises, and then we have clients in Florida who are absolutely on fire, filling up the offices, looking to do new construction, upgrades, acquiring more. It's like two different worlds.
Well, part of your issue with new construction, and I've had this conversation recently, in order to build an office building in a major metropolitan area, it takes you 4 years. Mm-hmm. First, you have to negotiate to buy the land, then you got to figure out what you're going to build there. You need to get permits and zoning and financing. So a lot of the new office buildings that you're seeing being finished now were actually started in 19, long before this issue arrived. Okay, so I suddenly you're going to have new empty office buildings, and the impact is on all of the other office buildings. Okay, because if you can rent space in my building for $23 a foot, why should you rent space in his building for $32 a foot?
Now, what do you think is going to go on with, or is going on, or likely to happen with multifamily? You've already talked about the 50-year-old buildings, but in general, are you seeing distress in multifamily, and what does it look like? Are banks selling notes? Are sellers trying to get out quickly? What's going on?
I don't see banks selling notes yet. Okay, I think the fourth quarter could be very exciting for that product. For multifamily, what I'm seeing is I read an article recently about the 5 largest multifamily syndicators. Okay, it might have been in BizNow, as a matter of fact. I'm not quite sure.
Yes, I saw that article as well.
And they've got $3 billion worth of debt coming due in the next 12 or 18 months or so. I'm not going to tell you where the equity is going to come from to backfill that, or what happens to the values. Let's assume that those properties lose 25% of their value. You've got a beautiful property right next door, lots of tenants. What impact do you think it's going to have on your value? It's going to drop it. During the great financial crisis, I got in trouble for standing up in a meeting and explaining that if the house next to yours was foreclosed on, and somebody threw a rock through the window and they replaced it with plywood and stopped cutting the grass, your value went down 5 to 10%. Mm-hmm. When 4 or 5 others in your subdivision had the same thing, your value went down 25 or 30%. That's the core problem here. Okay? Not what you're doing. What you're doing may be great, but if the guy next to you is suddenly in distress, you are too.
It's interesting you say that, actually. I have one son who has come of age to drive. I've got two more headed that way. And what I like to tell them is it doesn't matter. You've got to be a defensive driver because it doesn't matter how good a driver you are. It's the other idiot that you got to keep your eyes out.
Absolutely.
That's one you got to keep an eye out for. So do you think there's going to be, multifamily has been the darling of the investment world for the last, at least, I'll call it 10 years, maybe more, but particularly over the last few years. Is there going to be, do you think there is going to be a downturn for multifamily as well?
Let's break the multifamily market into two tranches. The A product, the B product, be just fine. Okay? The B minus product, the C product, okay? No matter how good a location is, when your interest rates, let's just be practical. Because I was quoted about an office building recently that had, it was 200 basis points over 1.5%, which was SOFR at the time. Well, SOFR is now 3 times that. Mm-hmm. Okay, so now they're at 6.5 or 7%. I don't care what your asset is. You can't, it would be extremely difficult to survive that. I'm seeing grade C, well-located multifamily right now, where the guy's had his interest rate triple, and he's losing $100,000 a month. Mm. He can't, and like I'm going to take you back to the crowdfunding. He doesn't have the money to write those checks.
So what's he going to do? Is the bank going to take it back? What's going to happen?
Absolutely. Absolutely. So, and at that point, assuming the bank takes it back, okay, because I don't see a restructuring in this situation. But if the bank takes it back, now they have to find somebody else to come in and take it. What's the building worth? That's the question that I found it really interesting in your conversations with Mr. Habucha.
Yeah.
Habucha. Okay. Absolutely. Nobody knows. Back to the issue. People don't know where values are or where they're going.
So, Henry, I'll tell you what, I keep asking you, where are we going and what things think, but you are one of the only people, actually the first person I've actually spoken to who has experience of the 1970s. So I've just got to ask you about that. I went through the savings and loan crisis. I started investing or was working for a ground up multifamily shop in Southern California from the mid 80s. So I went through everything subsequent to that. I landed in 82 in America. So tell me, what was the story? What was going on in the 1970s? You called it the REIT crisis. I didn't even know there were REITs in 1970s, but can you just describe what happened and what was that downturn all about?
Okay. There were both mortgage and equity REITs. By the way, one of the fortunes that Sam Zell made was from something called the Great American Mortgage Investors, a REIT based here originally that he bought. Okay. What happened was the commercial banks were making loans to the mortgage REITs. In Atlanta, the mortgage REITs had been created by our commercial banks. Most commercial banks, including Chase, by the way, as an example, okay, had their own mortgage REITs. Now, as something of a wise guy, I would tell people that the banks would lend money to the REITs so the REITs could make loans the banks didn't want to make. Okay,
a cynical perspective.
It was a funny way to put it, but it was the reality of it. So what happened with the REITs, and I don't see this happening today, because the banks had so much money exposed to these mortgage REITs. When the mortgage REITs would foreclose on a property, they would trade it to the bank for the bank's investment in the REIT. They were called swaps. Little different from today's swaps, but they were called swaps. And Citibank had billions of dollars into these mortgage REITs, which is how I got there.
And the REITs, and the reason that they had REITs is that because they could sell shares to investors, yes, like individual investors.
Yes, that was, I didn't really dig into that side of it, but I think so. Go ahead.
And in the 70s, what were interest rates like, Henry? What was the interest rate environment? How much money did you get on deposit? Can you remember? I remember the 80s. So when I came in deposit, I remember getting close to 12% on deposit for my savings in the bank. And I'm sure I remember mortgages being in the high teens. It was a high teens environment where you got a mortgage on a house or on a development.
I bought my first residence in 1980. I'm going to tell you.
Okay,
is my guess here, because I moved here. I moved to Atlanta in '79, so I bought my first condominium actually, and I think I was paying 12.5%, and I was happy to get it.
right.
Okay, so those were the Paul Volcker as head of the Fed in those days when he moved prime to 21.5% or whatever.
Right.
It turned out to be. So interest rates were extremely high at that point. And then they slowly began gradually to come down in the 80s until you came here in 82.
Yeah.
Until the tax law change of 1986,
Mm-hmm.
which basically stripped real estate of a significant percentage of its tax advantages.
Mm-hmm.
I described it as being, and you're in California, so I described it as being 80 miles an hour on the Golden Gate Bridge, and halfway across, the other half of the bridge was not there. Now, it took a little while for the car to hit the water, but it hit the water, and it hit the water in 1989.
That was Reagan, wasn't it?
Yes.
Mm.
And I'm not judging whether or not that was a good idea or a bad idea in terms of the tax law. I'm just observing the impact that it had on the real estate industry.
It really had a major impact, didn't it? Because it was that really triggered the savings and loan crisis.
Absolutely. That and some really dreadful loans by some of the savings and loans themselves.
Yeah.
And when I was at the Resolution Trust, okay, we would see a lot of those loans, and they were very badly underwritten. I'll leave it there.
So let's just explain, because a lot of viewers and listeners may not actually know what we're talking about. But there was a downturn that you've just described, largely triggered, not entirely triggered, but largely triggered by tax changes. It was a real estate downturn. It caused the failure of vastly more banks in the early 90s than the global financial crisis had than during the global financial crisis of 2007 and on. And what was the RTC? Just to explain a little bit, well, how did that come about, and what was your role? And just tell me a little bit more, some anecdotes of what kind of things that you saw during working for the RTC. I've only spoken to people that actually wanted to buy from the RTC.
There were more of those than there were of us.
Yes, and those are the ones telling the tales today. So hearing it from the inside, I'd be interested to know what happened.
Okay, the RTC was created by the federal government, by Congress, to deal with, I think it was 784 different savings and loans that failed.
Right.
So the RTC, along with the supervision side of the FDIC, okay, because the RTC was really a subsidiary, in effect, of the FDIC. Okay, hang on a second. I need to do one thing. Stay right where you are. I'll call you later. I have my phone is plugged into my ear. My cell phone is plugged into my
okay, and my computer, I'm actually intravenously connected to my computer.
So you have the same issue.
I can't get away from it. Yeah.
Okay.
Anyway, so the RTC, the Resolution Trust Corporation, right?
That's right, was created to take control over savings and loans when they failed. Okay. And 784, I think, was actually the number. And basically all of the assets, being loans and owned real estate, were transferred from those banks when they failed into the Resolution Trust. Okay? So assets were both somebody's house, okay, and or a loan on an office building, and kind of everything in between. And the congressional mandate was to liquefy, get cash in as many assets as quickly as we could. Okay, because that was Congress's oversight. That was what they wanted the RTC to do. So
it was to get assets in and then sell them, right? As quickly as possible.
Absolutely, as quickly as you can.
Basically a fire sale.
And by the way, if you take a look at the mortgage-backed security business, that's where it started.
It did, didn't it? Yeah.
That's where it started, because the reality was we had all these loans, some of which were good, which were then packaged into mortgage-backed securities and sold to the market.
Right.
Okay, so that was that. The troubled assets, the not so nice stuff, came to the SAMDA, Standard Asset Management and Disposition Agreement. That was the unit I ran in the Southeast, everything from Maryland to Miami. Okay, which included not only significant assets here, but some rather large assets in the Washington metropolitan area. Okay.
And your job was to sell them, was it?
It was first to figure out what they were, because the files that we got from the savings and loans weren't necessarily the best. So what we did is we hired third-party contractors who had expertise, for whatever reason, in dealing with troubled assets. And there were people out there. And I think we had 22 different contracts, as I remember it, $3 billion in assets, which back then was a big number.
It was when 3 billion meant something, right?
Yeah, it was a big number. And it was our job to basically triage them, foreclose where that was appropriate, or sell the note where that was appropriate. And we basically liquidated everything we had. Here's one of the great ironies of the Resolution Trust, which a lot of people have said negative things about over the years. We're the only, to the best of my knowledge, we're the only federal agency that was ever created and put itself out of business. Doesn't exist anymore.
Yeah.
Because we were successful thanks to the market. Thanks to the market.
Well, a lot of people made huge fortunes buying from the RTC.
Including Mr. Barrack.
Yes, at Colony Capital, right.
Including Colony Capital. And God bless him. And frankly, that's a large Barry Sternlick at Starwood. He made a bloody fortune because he had, like Colony Capital, he had cash assets and he was in a position to buy stuff. And they made a lot of money. God bless him. My job was to get rid of it.
Henry, let me ask you one final question. I'm just looking at the time. I can't believe we're almost.
I know. Sorry.
Like it's gone so quickly. I'd really love to hear more about your stories. But let me ask you one final question.
Please.
Actually, so I looked on your LinkedIn profile. So it talks about some of court-appointed receiver, but one of your other titles is Special Master. What is a Special Master?
A special master is a unique style of receivership. Okay, and it's a much shorter leash, if you will. A receivership can run a long time depending on what you're dealing with. A special master, the judge wants a response quicker than that.
Oh, is that it in a nutshell?
It's a similar function, but with a shorter leash.
I see. Okay. And I have worked with special masters before. It generally, as I recall, makes everybody quake to their boots when a special master's brought in for some reason, isn't it?
Well, it's kind of the same thing, even more than a receivership. I describe myself as a receiver as being the adult in the room. Okay, trying to figure out what happened and deal with personalities. And frequently, by the way, it's a lot of personalities. Okay, not only borrower lender, but family, partnerships, all sorts of different things. So
now you've
special masters.
So you've so let's wrap up with one. Did I say that was the last question? I was lying.
You get one more if you want.
I got one more last question, real last question. So you've been through 4 downturns. You've seen interest rates go up. You've seen them come down. You've seen government departments divesting of special asset of non-performing assets. You've seen more than most people in this market. What is the current market? How do you characterize what's going on now, and what do you see the next year, 2 years holding for real estate investors looking for opportunities?
I think that the real crush is going to happen in 2024 because you've got an enormous volume of loans coming due that no longer underwrite, having been a lender. Okay, you can no longer underwrite based on their cash flow or based on their value. You're a lender, you want to make a loan at 55, 60% of value. Okay, you want to do something safe. Good luck in defining value. You can't define it for me, and I can't define it for you. And it will be impacted by changes in interest rates, either up, which I think is unlikely at this point, or down, or in the individual market for whatever product you're dealing with. So the answer is next year is going to be really exciting.
It is. Henry Lorber, crowdfunding fanatic, principal at Lorber Associates.
Thank you, sir.
Thanks for joining me. It's been a real pleasure.
Take care. Thank you.
All right, that was Henry Lorber, principal at Henry Lorber and Associates. What an interesting gentleman. Actually, he and I ended up chatting for a good few minutes after we'd finished recording. And I kind of half regret not having kept the mic hot, as they say. But he shared with me some insights that maybe probably not the best to share publicly. Right, about where certain personalities and how they started in life in the commercial real estate industry. But one observation he did share with me is very interesting, is that CMBS, or the origins of CMBS, were in part to resolve the mortgage crisis that triggered the savings and loan crisis of the 1990s. So CMBS actually came out of that. It was very interesting. But anyway, I didn't record it, and we talked about some people who were involved at that time. So probably better that it's not public. Anyway, that's it. If you want to learn more about Henry, go to the podcast page at gowercrowd.com, as you know. And while you're there, do subscribe. If you're not already a subscriber to our newsletter, it goes out every Wednesday, and we cover the world of commercial real estate, syndication and crowdfunding and finance, and have a list of all the latest articles that have been published. It's a really fast, easy, and highly informative read. It comes out on Wednesdays, totally free, all there at gowercrowd.com. Henry, what a pleasure meeting you. I really enjoyed our conversation. We should definitely stay in touch. And if there is an opportunity, as this particular downturn starts to unravel or develop, what happens to downturn? Do they unravel or do they develop? Anyway, as it gets longer in the tooth, let's go ahead and connect again. Be interesting to hear what you are seeing in the market. And of course, to you too, dear viewers, I hope there's more than just one of you anyway. Thank you so much for joining me today. I hope you found the conversation of interest, and I look forward to seeing you next time here on the Real Estate Reality Show. But for today, this is Adam Gower signing off.